Well, hi, Chris Weston here, Head of Research at Pepperstone. Really exciting times in the crypto scene, and specifically we've got a very market focus today on Bitcoin. We're 41 days since the all-time highs. We've just seen the halving come through. For a lot of people, that's a fairly important part in the Bitcoin cycle. I've got a couple of absolute whales in terms of the crypto scene to break this all down, talk about their trading and investment thesis. I'm going to approach this from more of a trading perspective, long and short, and look at the characteristics of trading crypto. But the scene evolves, and we want to be part of this. It's a really important time. It's going to be a really interesting chat that I've got with Dylan and James today. We're going to break it all down for you. Well, hi, welcome back. I'm going to bring Dylan LeClair into the program, and also James Check. Two big dogs on Twitter. They've got a really ingrained situation in the whole world of crypto, both from an on-chain data perspective, from an investment perspective. Very reputable thought processes indeed. James, Dylan, welcome to the program, lads. I'm going to start with you, Dylan. How are you going? And do you want to just give us a bit of a background into who you are and how your journey into the crypto scene?
Yeah, Chris, appreciate you having me on. Super excited for this chat. A little about me. Well, I think four or 5 years ago kind of went all in on the thesis that Bitcoin is an engineering solution to a world where financial repression and the perpetual debasement of fiat currency is an absolute certainty. And not cryptocurrency broadly, but Bitcoin, absolutely scarce decentralized digital cash, is the $100 trillion idea. And so, that's a rabbit hole in itself. So all of the data around it, the fact that we have a transparent ledger of ownership makes it actually one of the most interesting and unique asset classes or instruments that we've ever seen. And so it's I've been in this space full time 24/7 since then. And I've kind of done a whole bunch of stuff, from writing 2 years of research to working with a liquid fund to kind of navigate these markets. So yeah, really excited to chat and kind of bounce some ideas off each other.
Well, it's our benefit to have you on, mate. So thank you very much for joining us. And James, fellow Australian, it's great to see, and obviously such a big world where so many people are heavily dominating from the US and Europe as well. That we've got two Australian-based analysts in the house. So welcome to the program. And why don't you tell us about your involvement in the crypto scene?
Thanks, Chris. Yeah, no, you got to put Australians on the map, right? We do a lot, right? And you just got to sing about it. So yeah, I mean, I started my journey. I actually was a civil engineer, so I used to design basements, tunnels, mines, everything underground. And in that world, you learn a lot about probability and risk. And in 2018, I discovered Bitcoin. I paid my tuition fees, as you do in a bear market, but I just love the idea of markets and just the way price moves, all of the emotions and all the investor psychology that gets baked in a price. And Bitcoin, as you mentioned, it's such an incredible asset because we can actually see the whole ledger. And I fell down the rabbit hole of on-chain analysis roughly 2018, and it's about as long as the discipline's been around. So I think I would have been one of probably the first 5 or 6 guys who started really writing about and educating about on-chain data. Spent about 3.5 years working with Glassnode as a data analyst and led the analyst team there. And more recently spun off to found Check Onchain, which is an on-chain analysis, well, kind of based, but we still look at derivatives and all the other market factors. So really understanding how the Bitcoin market trades, but with a kind of unique perspective of what Bitcoin itself is actually telling us.
Yeah, well, I want to focus on some of that on-chain data and how we can use that for more classic trading strategies. I mean, for me, what I really like about that, the fact that it's open 24/7 and you minimize that gapping risk that you would get from, for example, with equities and other markets, is that you get this real strong propensity to trend as well, like you do with agricultural commodities. If you're trading momentum, if you're trading trend following strategies, you often see it really going in one direction. And I love that for those type of strategies. It works well, in times of mean reversion as well, but I feel like that propensity to trend, but also from a day trading perspective as well. If you don't want to hold those positions overnight, you do get this situation where you can easily get 6,000 points in a day, high to low range. So for the day traders who are directionally agnostic, you're just trading the price intraday, you get that huge range expansion like we saw in March where it was trading 6,000 points. I mean, the average sort of 5-day high to low range in Bitcoin's come back to about 1,500 points. but relative to the spread, it's pretty good. So you get good liquidity, you get really good intraday trading conditions, but you also get that propensity to trend as well. So I'm really interested to see how you can use some of those classic technical strategies and actually use and heighten that with some of this on-chain data. Let's just have a set the scene, and then we'll go into the halving, because it's obviously a big situation. We've got that sort of in the rear view mirror now, but we want to talk about hash rates and what this means for the sort of price in the short term. But I just want to set the scene, because if we just use Bitcoin in isolation rather than going to some of the meme coins, altcoins, for example, you had this move up, between September and into January of 90 or 96%. We had this bit of a pullback. We traded into the all-time highs in March. There was another 96% move that came through. And really, we've just been sort of just trading in a bit of a short-term range between the all-time highs. As I say, it's been about 41 days since that point. But we've seen good buying, coming below the 6,000 level. So we've seen about a 17, 18% pullback from the highs. And really, we haven't seen much more than a 20% correction in this bull market that we've been seeing. But we're just sort of trading in a bit of a range. It looks like this wants to kick a little bit higher. I'm hoping, from a momentum perspective, that this really starts to kick higher. I'm seeing fundamental reasons why that can. Dylan, just talk about, in the short term, while we're setting the scene in terms of price, how have you been actively involved? How active have you been in the market in the short term?
Yeah, well, I think there's a few things of note so far this year. One was obviously the ETF's approval, and that was a large catalyst from not only a narrative but just a pure flows perspective. And from a narrative perspective, this is an asset that has been called a Ponzi scheme, a money laundering index, and now the largest institutions in the world, largest asset managers in the world, are offering products not because they're Bitcoin maximalists, but because their clients are knocking down their doors, demanding that they do. The second point is that this bull run, right? The fact that we've made new highs, as Bitcoin often does, and whenever you look at a Bitcoin, you look at the Bitcoin exchange rate on a linear chart. Like right now, we're looking at a log scale with the drawdowns visualized as well. Whenever you look at Bitcoin on a linear chart, it either looks like a somewhat of a bubble or a large bust. And that's the beauty of this asset. But really, this bull market and all Bitcoin bull markets are primed because of the actions of the bear, because you have an increasing hodler base as this asset is monetizing that is acquiring it. They're price agnostic and they're acquiring more. So if you check the tape, you look at what Checkmate was saying all of 2023, you look at what myself was posting on the timeline as well. Just a data view, the data-driven analysis was all it takes is a inflection in the macro outlook, and this thing's going to absolutely rip, because it had never been more constrained on a supply side. So you have an absolutely scarce asset. It's extremely inelastic relative to demand. Like unlike any other commodity, it is inelastic to additional demand. So if oil doubles in price, if gold doubles in price, if wheat doubles in price, if any agricultural or industrial commodity doubles or 10x's in price, all of a sudden next year's production, the next season's production, there's going to be a lot more investment into actually digging it out of the ground per se. Bitcoin is very much different. And so because of that, it trades very much what someone may look and say that's irrational, but really it's just extremely inelastic. And it's why you get this, extreme volatility both to the upside, to the downside. So the fact that we had a new all-time high before the halving, if you asked me before the year, I would have been pleasantly surprised. I was pleasantly surprised that the ETF flows, IBIT has been the most successful ETF launch in history. There's obviously institutional demand for this. And I think a lot of investors are waking up to the fact that never mind the next week or the next month or the next quarter, the US fiscal situation, the global macroeconomic situation, even after a once in 50-year inflation shock, is not improving. It's actually getting worse. Yeah. And so there's there's a realization that, oh crap, I need long-term debasement protection. And Bitcoin at $1 trillion is an unbelievable bargain. And I think a lot of people are looking at a linear chart saying, well, it looks a little expensive. And I think that's the wrong way to look at this.
James, Dylan just touched on an important point that we hit an all-time high, 74,000 before the halving. I think that's the first time in the 3 other episodes that we've seen an all-time high. I mean, how significant is that? is there any significance towards the fact that we're trading an all-time high prior to the halving? Does that make this halving slightly different? How do you interpret that situation?
Yeah, great question. In terms of just like a very structural sense, there was a narrative in the 2022 bear market that price cannot go below the previous all-time high, and it of course did. And there was also a narrative that we can't all-time high before the halving, and of course here we are. So in my view, like I wouldn't put too much weight to that mechanic. What I would do is say, well, how did we get here? And it actually might be worth bringing up the chart that I've got shown here. This is just a visualization. I often find that visualizing things in a different way can just give you a really neat perspective. What we're looking at is all of the previous bull markets indexed to 100. And then up the top in the area charts, we're looking at the drawdown during that cycle. So not from the all-time high, the drawdown of that cycle. And if you can believe it, since FTX blew up back in 2022, this entire run we haven't had, you mentioned before, a 20% drawdown on a closing basis. So when we look at how do we actually get to an all-time high pre-halving, 2023, we saw an enormous amount of supply just getting soaked up. I call that kind of coming off the bottom of a bear market, like an uncertain recovery. Everyone's got a bit of PTSD from the bear market. Everyone expects it to go lower. And yet we just haven't given back a 20% correction. And you can see the distinct difference. I mean, it looks the most like the 2016-17 market, which was pre-derivatives, by the way. So that blue area, really that's describing a spot-driven market because there literally were no derivatives at that point in time. We have futures, options, and these things are expanding at a rapid clip. And yet it looks a lot more like a spot-driven market, and it's actually got even fewer drawdowns. So in many ways, it speaks to a tight supply, spot-driven regime, and really these ETFs are a whole nother level to it as well. And impressively, during this current correction, there was a lot of concern that these ETFs would just as quickly unload their shares. We just haven't seen those outflows. It continues to be very, very firm-handed, which is great to see.
Yeah, I think the ETFs got to, I think it was the 21st of March. That was the high that we saw in terms of the ETF fund flows. And I look at the sort of the 10 ETFs. I've taken away the Grayscale because we've actually seen big outflows this year from Grayscale and their ETF. But it was interesting because the high that we saw on the inflows going into the 10 ETFs was pretty much at the high we saw in Bitcoin. So there has been a reasonable correlation, and we'll talk about the future of Bitcoin and we'll touch on the ETFs as well. I want to go into the halving itself. Let's move on to that stage. So I'll push this one back to James. I was running a Google scan. I went into my media monitor to look at the level of press that have been writing about the halving itself. And it's just been wall-to-wall blanket coverage, which is great for the crypto scene more broadly because the press have done a great job of bringing people back in and focusing on this. And obviously, if you look at the positivity rating, all the articles are very, very positive about the outlook, the scarcity angle, the reduction in future supply, the potential for the supply-demand dynamics to pick up. But James, just talk to us I know there's a lot of people who are watching this who have probably heard a million podcasts now about the halving. And then I'll ask you a question in a second, Dylan, about the sort of mining side of things. But just for those people who are watching this for the first time and are new to the sort of the crypto world, just explain to you your take on the halving for Bitcoin subsidies production and how important this is in the cycle.
Yeah, for sure. I mean, it's funny because the longer you spend in Bitcoin, the more you see these narratives come and go. And there's always people who come in and go, oh, the halving is the best thing since sliced bread. So to give a very quick overview, pre-programmed in the Bitcoin protocols, every 4 years, the amount of new coins that get minted will halve. So it started at 50 per 10 minutes, then it went down to 25, then it went to 12.5, 6.125. And we've just halved one more time. So it's down at 3.125 Bitcoin per block. So what that essentially means is that the new coins coming to the market is fewer. And also it means, so there's kind of two components. There's fewer coins coming to market, and usually the adoption is on the ticking higher. So you've got more demand meeting less supply coming to market. But for the miners, and Dylan could probably touch on this later on, the miners lose 50% of a major portion of their revenue. And it's a really cutthroat industry in the mining space. So that's kind of two separate ways to look at it. So from the mining angle, I'll leave that for Dylan to touch on. From the market perspective, and this is why I love looking at this data, because when I bring things into perspective, actually, I've got a chart shown here to really put things into a bit of view. The question is, how big is the impact? So we're talking about the daily coins coming to market going from 900 to 450. Now, if we put that into dollar terms, it's about 65 million that was being issued to miners before the halving, and then 50% of that, so something like 32 million today. So how big is a $32 million drop in overall supply? So I've actually got 4 traces shown here. If you ignore the price chart, there's the light orange, which is futures volume. There's the orange, which is spot volume. There's the blue, which is the ETFs trading on the stock exchange. And if you really, really, really squint hard enough, you might see that little red line down the bottom. That's the miner issuance. So we're talking about the actual impact, the total amount of coins being issued to miners is 850 times smaller than daily futures trade volume, 200 times smaller than spot, 100 times smaller than the ETFs. Now, given that the halving is literally a halving of that, you can actually double all of those multipliers. That's the difference. That's the actual impact of the halving. So from a market-based perspective, it kind of just blends in. But what I think is actually much more important, and I think you mentioned it earlier, it's the narrative, it's the story, it's the fact that Bitcoin has this monetary policy that just does its thing. None of us can change it. And you contrast that with the global central banks, and you've just got this night and day approach. So I think in many ways, it's more of a narrative thing rather than a necessary market impact. It's very small in that regard. One final point, it is still $30 million a day that doesn't need to get soaked up. So it's not going to be a net negative. And it is net one side. It's only sell side pressure. But in the grand scheme of things, it probably fades out. More important in the long term, less in the short term.
Yeah, Dylan, James touched on the mining side of things. These are the primary guys who are going out and solving out the cryptographic puzzles, the hashes effectively. I don't know how much you focus specifically on the mining industry, things like, I was looking at some of the listed plays, Riot Platforms, Marathon Digital, Core Scientific. They've had a really, really big rebound in the last 2 weeks or last week or so. I mean, I'm looking at CleanSpark, for example. It's gone from $14 up to $21. I'm not sure how you look at that, or whether you would look more at the hash rate, for example, which has pulled back a little bit, but perhaps not much as some people have been looking for. And ultimately, what does that tell you? Is there any kind of read through into the way that their equity is and the hash rates into the underlying Bitcoin itself?
Yeah, totally. Well, the public mining space is something that is relatively new. A lot of these were listed, post 2020. So this is kind of, a second cycle for a lot of these companies, the first for some of them. And mining it's important to understand mining is brutally competitive. Unlike any other industry in the world, it has a difficulty adjustment. So the more you chase this carrot, the more computation you throw at the Bitcoin network, the more difficult, quite literally, it becomes to mine a block. So the more and more, and so this incentivizes an increasing level of efficiency globally, right? This is a global race to find the wasted, lowest cost, most efficient power sources, and anyone else, anyone that's using expensive commercial power has to turn off. So there is this natural cleansing process that oftentimes in something like the traditional financial world, or just industry in general, especially one very tight with big government, you don't see, right? There's kind of the full business cycle hasn't been able to play out. In Bitcoin, it's the opposite, and they kind of get this programmatic washout. So hash rate, right? Hash rate's up and to the right basically forever. There's been somewhat of a diminishing level of growth, but the growth is still, in absolute terms, extremely impressive. And that's because there is this insatiable demand to monetize waste energy and more efficient ASICs. If you follow Moore's law, semiconductors becoming more and more efficient, these ASICs, these Bitcoin miners become more and more efficient, and the old generation miners are still online. So the public mining vehicles themselves, if you look at them, really there's the time, and this is somewhat of a generalization, but you want to own the miners when price over a certain period of time is broadly is outpacing the growth of hash rate. And all other times, if hash rate is going up and price is going down, it's a pretty brutal time. So I think in terms of the miners, how I look at this on a 12-month time frame is 2022, 23, and I guess the start of this year. If you look at the price growth versus just the share price versus the market cap, a lot of these public miners have market caps at all-time highs, but their chart doesn't look all that sexy because they've diluted so much, right? These guys all had to survive the depths of a pretty brutal bear market, and they used that share dilution to build out their fleet and to remain liquid. So I think most of the dilution has taken place, and you have a lot of these pubcos with, some of them have obviously different sort of all-in production costs, but a lot of these pubcos, have a decent runway, and in a raging bull market will serve as pretty extreme beta. So on a kind of a medium-term time frame, I'm pretty bullish. On a longer-term time frame, like if you're just thinking about, how most Bitcoin holders think of just buying Bitcoin, and waking up in a decade or 5 years or a multi-year time frame, the miners, if you just look through history, have actually on Bitcoin terms underperformed quite because it's really, really challenging to outpace this asset itself. Yep. So, but there is that kind of 1 year, 1 out of every 4 year, small window in each cycle where these things absolutely rip, and that's when price is going bonkers, and hash rate, just given the lag that these things see because of the physical infrastructure the Bitcoin mining requires, there is that lag. So when price rips, these things go bonkers, and then that physical, that capex, that build out comes later on, and that's where these things don't do quite as well. So I think we're in that period where they have underperformed Bitcoin to start the year after a great 2023. And I think if we're still in somewhat of a secular bull market, which I believe, then these things will be good, good for a good swing if you can handle the volatility, and that's a big if.
James. I think a mental model that I use is probably not going to be too dissimilar to GDX, where GDX makes a lot of widowmaker trades as you're waiting. The gold price is ripping, but you're like, why aren't my miners going up? I think that's probably the right mental model, because then one day they just go. Yeah.
You got Clean Spark, which I was looking at their recent releases, and they've got an all-in cash cost. I think they're the cheapest of the listed miners at 31,000. So they're mining, when you take into consideration electrical costs and fees and all those factors, they're producing at $31,000 per Bitcoin effectively. So that's probably one of the best. If you go into something like Riot and Marathon, they're releasing their earnings on the 10th of May. So maybe that's something to watch out for. But going back to the Bitcoin price, and while these guys are obviously at the forefront of mining architecture, what's really important now is a really quick question actually to you, James, before we can move on to the actual thing. If we were to see consolidation in the industry, some of the higher cost producers, the guys who have got, I think they measure the efficiency by joules per terahash, anything above 40 joules per terahash is you need a Bitcoin price of 90,000 to stay in business. Let's say you get some consolidation in the Bitcoin scene, and therefore you're going to have less computational power going through, and you see a lower hash rate. Does that make you more nervous about the Bitcoin price because it's a less robust system? Would you potentially take some longs off the table? How does the hash rate influence your conviction about the robustness of Bitcoin's architecture?
Question. So here's a fun fact: the hash rate has been an all-time high in every single halving event. And what this tells you is just that the fact that hash rate is going up means that one of two things is happening, or both. You've either got new rigs being purchased and brought online, that's CapEx, or you've got new efficient ASIC models being designed and built, that's R&D and also CapEx. So when I look at that as a broad picture at the whole mining industry, that is telling me that not only is the revenue sufficient, because if they were stressed, they would just be running the machines they have. They wouldn't be buying new ones, and they wouldn't be developing new ones. So the fact that we have hash rate continuing to climb means there's enough cream in the revenue for the aggregate miners to continue to invest in new CapEx. Now, internally, you can have some miners with a better balance sheet and a worse balance sheet than others. So even though hash rate in aggregate can be heading higher, you can actually have some miners who go bankrupt and go broke. Now, you have to remember that every single miner, all their machines, they're basically like a physical call option. They have a limited lifespan. At some point in time, they'll be obsolete in terms of their efficiency. So they have to buy them at the right time, at the right price, get them rigged and running, and extract as much value as they can out of that option before it expires worthless, because it will expire worthless. So the net result is that if one guy's balance sheet isn't strong enough to make the cut, he will fold, and someone else will come in and buy those machines off him at a much lower machine cost basis, spin them up, and away they go. So hash rate going down actually doesn't, personally, when I look at my price analysis, hash rate actually, to me, has very, very low signal. I don't use any kind of hash rate. It doesn't affect my conviction in Bitcoin, the network, because the system will naturally wash these guys out, and it's designed to do exactly that.
Perfect. James, let's switch gears a little bit. I bring up the miners and that because obviously it's when it comes to the halving, they're going to be the natural things that are issued. It doesn't change the amount of outstanding coins in 19.7 million coins in the ecosystem, which is why we haven't seen this big being a liquidity event or a volatility event in itself. But what it does is it changes the dynamics as well from the mining perspective, but into the secondary market, the supply growth, the amount of new tokens that are being produced relative to those that are outstanding will come down to about 3.3%, which obviously that's the supply element that we talk about, supply demand, which everyone's getting very excited about. But let's talk about the near-term kickers, Dylan, because, let's talk about the short-term trading outlook or the short-term volatility, because the way I'm saying this is you've got that supply issue. I think, you've got the ETF side of things. We've talked about that and the levels of inflows into the 10 ETFs have dissipated a little bit recently. But if we look at the kickers in the short term, we've got an Ethereum ETF, which we thought probably could come in May. It looks like that's going to be pushed out a little bit further, and we can see that in the Grayscale ETF, which is trading at 26% discount to net asset value. The UK's got a bit more excited recently. They recently approved a spot ETN. Similar situation in Hong Kong, where we've seen an ETF given their blessing for both Bitcoin and Ethereum. So it does seem that from a government level that the ETF scene is becoming. People are tolerating it a little bit more. We saw in Japan the GPIF, the big sovereign wealth fund, saying that they may look to invest in ETFs going forward as well. So obviously that's something we are focused on longer term. There's just I think there's a lot of positive kickers. On the negative side, obviously you've got the SEC, looking at Uniswap as well. And we've seen a bit of length coming out of the market on what we've been seeing recently with a liquidation when Israel, put out drones and missiles to Iran. But I'm looking at the macro situation. I'm looking at the fact that we did see a bit of a backup in bond yields. The 10-year got nicely above 460. We saw the 2-year government treasury above 5%, real rates moving up. But that's come back a little bit now. I think people are saying that bond yields have probably have peaked up, which could be seen as a negative for Bitcoin. Risk assets pulled back a little bit, but now we're starting to see some positive flow back into the S&P and the Nasdaq as well. The dollar's come off its highs recently, so I'm seeing some positive flow, which is probably why Bitcoin's trading just above 66,000. Dylan, talk to me about your short-term outlook for Bitcoin. What are the big kickers, and how you're sort of complementing with some of the on-chain data, for example?
Yeah, totally. So I think, if we can go to slide 14, I think this really sets up it really lays out the situation quite well. It's actually the blue chart. It's the area chart. It's the long-term holder percentage supply. If we have it. Yeah, there we go. Great. So every Bitcoin bull market, if we're just thinking about Bitcoin in general, and I'm happy to touch on the macro, right? During last week's kind of puke on the fears of the Iranian and Israeli conflict, you had VIX year-to-date highs, equities where, the SPX traded down 6 days in a row. Bitcoin certainly, pulled back 20% and change, or give or take from the all-time highs. And obviously the dollar strengthening relative to some of the other currencies, but all fiats are competitively debasing on a longer time frame. But if we look at just Bitcoin, right, what really primes these seemingly random, irrational animal spirit bull markets, especially when you're looking at this on linear scale, is again the supply, this supply constraint, right? So you can see this long-term holders. It's not the exact technical definition, but it's essentially coins that have been held for longer than 6 months. And if you run a data analysis, the reason that this threshold is chosen is because after that 6 months, statistically, they're much less likely to spend those coins in the future, the longer they're held. whereas the coins that are changing hands every day, every week are much more likely to change hands again. So what really sets the table for these crazy parabolic bull markets is this massive accumulation and supply constraint. And what you see at the start of really every one of these, raging bull markets is right around the point of the prior all-time high. The all-time high set 2-3 years ago feels like a distant memory. You start to see some of this hardcore holder base that caught knives, that was getting, just absolutely, beat to the ground with the Bitcoin exchange rate for the last couple of years amidst an 80%, 70% drawdown, take a little bit of profit, right? So they don't sell all their stack, but they treat themselves, they peel a little bit off. And we see that it's not just an anecdotal thing. We see that in the data, right? So that accumulation turns to a slight distribution. And so the ETFs, like the unlocking of Grayscale's coins that were kind of held captive, hostage for 3 years, that's certainly been there. But I would say if we're just looking at this from the UTXO set, just a fancy word for the Bitcoin supply that we can see with complete transparency, this is nothing new, and we see this every bull market. So I think if we go to the short-term holder price, that I think it's number 9, as long as Bitcoin is trending above the average cost basis of this short-term money that's not the long-term holders, but the opposite, right? The money that's in the market over the last 6 months that have swapped hands.
So short-term. Sorry to interrupt. Short-term is designed. It's seen as 6 months. So that's the 6 month holders, right?
It's the fast money. So people who acquired in the last 6 months. Yeah.
Oh, yeah.
Yeah, it's yeah. I mean, there's a little bit of more of a math there, but it's more or less that. And what we can see is just given the absolute scarcity and supply and elasticity of this asset, when you could see in a bull and bear market this level, that average short-term holder cost basis, similar to kind of like how some traders choose a moving average or kind of take momentum strategies. This is a very, I think there's a very much a psychological aspect to this.
Yeah, right.
And in a bull and bear market, it's very much a strong support in a bull and strong resistance in a bear. So as that level is like 58.5, 59,000. And in bull markets and bear markets, we frequently kind of retest this level. And often it's, again, very, very strong support. So as long as we're above that kind of price level on a shorter to intermediate time frame, there's, I think, very much sort of a chase underway where these players, this new money, anyone that's buying ETFs, anyone that's kind of had to change their view on this asset as it's become increasingly institutionalized, as Larry Fink has given it a stamp of approval.
He's the man now. He's a poster child of the scene, isn't he?
So
what a flip.
And I mean, I think again, the Larry Fink stamp of approval is not the fact that IBIT has bought all these coins. It's the fact that, oh crap, it didn't die with FTX. It didn't die after, it's not just a zero interest rate phenomenon, right? Bitcoin made new all-time highs with the Fed funds rate at 5.5%, right? So there's a lot of previous theses and previous kind of preconceived notions that have had to been, changed, that have had to be written off. And so with that, allocations have to change. Yeah. And so I think that's, going from a 0% to a 1% allocation for global wealth in an asset that has $1 trillion market cap, but, isn't nearly, it doesn't take nearly that much to send this thing to, even to double it, right? It's $1 billion into this asset can really move the market in both ways. The liquidity and inelasticity cut both ways. But this is why it trends so hard, right? It's just because that holder base, that rabid holder base, doesn't like to let go of their coins.
I wanted to touch on the ETF. I read this quite an interesting stat, and then we'll go back. I wanted to talk to you, James, about in the last 100 days, since the adoptions of the 10 ETFs, there was the equivalent inflows of 222,000 coins effectively were bought by the ETFs. In that time, 90,000 coins were mined. Over the next 100 days, we're going to see 45,000 coins effectively mined. So, you do the maths from that situation. Dylan was talking about momentum strategies, and he brought the short-term holders index, which I think is one that could be quite useful. For me, when I get that breakout, you might have. I like to see, for example, price come together. You see lower realized volatility. You see that in, say, for Bollinger Bands, and the longer that goes on for, the more excited I get about a potential breakout one way or the other. when it finally reveals itself, it can be very powerful, and that's what I love about Bitcoin. You don't know how long it's going to go on for, which is why I sort of take a more systematic approach with where my stops are, using moving averages, for example. But I don't know how long this is going to go for. I don't know how long it's going to kick. I just stay in the position for as long as the system tells me. From a fundamental perspective, we're looking at those flows and those various factors. But what other things that can you use for an on-chain data to tell you about who's buying whales versus retail? What does that mean? Do you want to see more whales buying? Talk to me a little bit about realized price and how you can use that as an indicator as well.
Yeah, absolutely. So, I mean, on-chain data is incredible because we basically get X-ray vision into what the whole market is doing. We can see coins going in and out of exchanges. We can see what their cost basis is, how long they've held them, and if they're locking in a profit or a loss. So all of this stuff is really, really powerful because human beings in any market, we tend to all behave very similarly. If you think about the sophisticated investor, what are they really good at? They're good at knowing what the crowd does. And when you know what the crowd is doing, it's like having that friend who's always wrong. If you can see what that friend who's always wrong is doing, and you trade against him, it puts you in a much better position. So you mentioned the realized price. So I'll bring it up on the next chart. The realized price is essentially the cost basis for every coin. Now, Dylan mentioned before, we've got long-term holders, short-term holders. You can look at it from whales. You can slice and dice the supply however you want and get a cost basis for all these different groups. So it's a beautiful tool for mean reversion because it's essentially where everybody's literally financial anchor is. It's their cost basis overall. Now, we can turn that into, this is called the MVRV ratio. It's literally just the ratio between price and that cost basis. And to really just think about what this is describing, this is how much unrealized paper gains, high values, or paper losses, low values, the market is holding. So if we think about when would we expect these trends to finally break, it's when there's too many guys who are too rich and their portfolios are too green that the incentive is so strong they're going to just take chips off the table.
So it's more of a mean reversion situation.
Exactly. So what does a bottom look like? It's when people are just beaten down. They've had their portfolios are down 70%, and only the strongest holders who really get this thing are still here. And essentially, if you think about when a bottom gets formed, who do you want to be in the trenches with? They're really the guys who are willing to buy this thing every day, all day. I don't care what the price is. I'm here for the long haul. So you really get to see that very commodity-like behavior. Now, the next one is really looking at momentum. So you were talking about how do you know when this trend is a bust? And whilst you've also got all these guys who go into a lot of profit, what we're doing here is just doing a very simple 1 year moving average crossover of that MVRV ratio. Now, when lots and lots of guys buy very high, lots of people buy too high at too high of a price, and then the market sells out from under them, their unrealized profits, all the fun and the games and the green portfolios very quickly go red. So when you've got like a trapped buyer base at a very high level, this thing will slice through its 1 year moving average and get this beautiful negative crossover. So on a more macro view, this is the kind of tool that I'm looking at to really track those sentiment breaks, those things that just put too many investors who bought too high, or flip side, when a whole bunch of people capitulate and the smart money buys the bottom, you'll see their profit go from in loss to in profit in very quick order. So you can use this to really gauge that longer term sentiment as well.
Is this what you use as well, Dylan? I mean, have you got any tools that you like to use other maybe than just normal generic technicals to give you a sense of the strength of the trend, the strength of the buying, and whether you stay in the position, and ultimately, what is it telling you about the current situation now?
Yeah, well, I will say, and this is this is somewhat of a shell after learning from him for so many years. James is actually, if you go to checkonchain.com, he has a suite of tools built out for free for people to use and kind of experiment with some of this stuff and kind of get their feet wet with this data we're talking about. Because for a lot of this data, the absolute giga brains, the brilliant computer scientists, you can spin up a Bitcoin node that you could download open source software, and you could go into the supply yourself and you could pull out this data and you could look at it. But the beauty is we now have some brilliant analysts that have already done the work and data scientists. So we have this a lot of these tools out there. Yeah. And so the interesting thing is that despite having this open, transparent ledger, despite Bitcoin being, breaking new highs, and despite this, suite of tools and general kind of, I would almost say like a new form of economics in a way, right? It's like, imagine if instead of waiting on the CPI report and waiting on the Fed data to update every week, or waiting around for the FOMC 8 times a year where we all listen to one guy and try to interpret his tone, we just have the data available and we have an open, transparent ledger. You can see, imagine if it wasn't like you were waited on a report from a bank to see what the, currency flows were. You could just see the flows. And so
Bitcoin gives you a quarterly report every 10 minutes, essentially.
Exactly. Every block, right? And similarly, a bit more of a, trust involved. The ethos of this, broader crypto market with the exchanges, right? A lot of this exchange data, the derivative data, the funding rates, the interest rates, you don't have to pay $100,000 a year to an investment bank. You can just see this because they publish it every 10 minutes or every, couple hours for free, right? So we can see that, at the $70,000 highs, traders were paying 20, 30% annualized rates to long Bitcoin on perpetual futures. Yeah. And that's since then, since the Iranian, the kind of the retaliation and the, somewhat of a liquidation briefly under 60,000, for the last week, futures have been trading under the spot market. So you have this kind of this interesting interplay between, the spot buyers, the people that are going in and exchanging $1 of fiat cash for Bitcoin, for Satoshis. And then you have the traders that are either trend following or they just get exuberant, longing or shorting. And again, these crypto exchanges, you can put on a 10x leverage position, a 50x leverage position. So it's like this volatility that's already, otherworldly for a lot of traders and asset managers, juiced up, levered up. Yep. And so with that, I think you kind of see these really interesting opportunities, right? Where, someone from traditional finance says, wait, what do you mean? I can go on with Bitcoin collateral and I can short the thing. I can be delta neutral and I can get a 25% annualized return. No way. That can't be true. And it very much is, because there's a whole bunch of holders in this space. There's a whole bunch of people that think in Bitcoin terms and think dollars. I don't care if it's a 12% yield. I'm interested in acquiring more Bitcoin. I'm interested in longing my longs per se. And so every once in a while, we really have to wash out that, that crowd. And, while maybe it's not as the funding rate, that kind of variable interest rate isn't as negative as we've seen in the worst of times, the March of 2020 lows, or November 2022, where actually you get paid, literally paid interest rates, a variable interest rate every 8 hours to long Bitcoin, right? Shorts are literally paying longs in the most worst capitulation events we've seen. Funding's flat, right? So essentially that variable interest rate, right? There's no central planner. It's essentially what's the futures price relative to the spot rate, the spot index. And so we have this really interesting developing, not only the Onchain data, but also this derivatives complex, which has undergone a lot of change. If we look at the last bull market, during the peak, during the Coinbase IPO, MicroStrategies, borrowing billions of dollars, Bitcoin has gone from 10,000 to 60,000 in the span of about 3 or 4 months. What you saw was a bunch of players were paying 30, 40, 50% annualized interest rates to long Bitcoin and crypto broadly using crypto collateral. So 70% of this derivative complex was collateralized with Bitcoin itself, or with crypto itself, crypto margin, right? And now that landscape, that environment is completely reversed to the point where right now about 30 to 40% of this derivatives complex is Bitcoin or crypto margin, and the rest is dollar margin. Stable coins, or in the form of a CME, they're using a treasury collateral, dollar collateral, right? Yeah. So if you think about the profile of those longs or of those derivative positions, right? If I'm long Bitcoin with Bitcoin collateral, it's great in a raging bull market. It's great when Bitcoin's going parabolic. But when Bitcoin reverses, it gets ugly really, really fast. There's a convexity there that it really kind of juices your returns, but also, that margin call comes quick. Yeah. So now with a dollar collateralized futures market, and in the last couple weeks or so, a real cool off in the funding rates, that variable interest rate, we have a really healthy environment in the derivatives landscape. And I think that this kind of change in the underlying collateralization has really played into the fact that we've really only dipped 20% from the highs. And can that change? Obviously, but I think that plays a big role in it being less volatile to the downside and kind of being more of like an orderly walk up. And I would expect, during the peak mania, as this, changes and the animal spirits return in some form. But for now, it's the derivative market's very much in a really healthy spot. Yeah. And I think the Wall Street interest in this asset as well is going to, really help keep these basis trades manageable, right? Yeah. Where, okay, you have a lot of, let's say, hedge funds, long short funds on Wall Street that are very happy to long IBIT, long the spot ETF, right? Get Bitcoin spot exposure and short the 1 or 2 or 3 month out futures, have no delta or no directional risk, and harvest a nice 10, 15, 20% return. And that's very much healthy. And I know that sounds pretty outrageous, but I promise you, in Bitcoin markets, that's like, that's the standard rate. So it's a pretty healthy spot.
Yeah, very nice. Interesting one. James, I don't know who's got the experience in this world, but one of the things we were talking about, obviously, with Bitcoin being fungible, I'm interested in the arbitrage opportunities that obviously exist, and how much you speak to people about doing this. I'm more from the high frequency side of things. But, if one exchange is trading one price and you can move your coins across and get inside of spread, how big is this world of arbitrage between big players trading prices between different exchanges? How much of that influences the price going forward? Are you involved in that world at all?
I'm not directly involved, but in terms of just to give you a bit of a sense of scale, so with on-chain data, we can actually track coins flowing in and out of exchanges. Right. So there is, on any particular day, tens of billions of dollars flowing in and out of exchanges. It's quite incredible. Quite often it's something between like 30% is a typical day. Sometimes it's 80% of spot volume is flowing in and out in deposits. So there is a huge amount of arbitrage that's going on. In fact, last I checked, exchanges was something like 60% of total on-chain volume is something to do with an exchange, right?
And so who are the players? Who are the players doing this? Is it going to be is it going to be your Citadels, or is it going to be your is it actually going to be the miners? Who are the big players in this world?
There's a whole bunch. So obviously the miners have to sell at some point, so they're going to be some part of it. But I would say they're going to be more one-directional, right? They're going to be sellers. They may be using options to sell covered calls, because that would be a nice strategy to just kind of get that extra return until they finally sell the coins. You're going to have there's a lot of crypto native firms who have been doing market making for a long time. And in many ways, I actually think that Wall Street is probably less involved. It's more so going to be the hedge funds and the prop trading shops, because Wall Street usually can't. I mean, the two biggest exchanges in the world is Coinbase and Binance. And Binance, I think a lot of companies in Wall Street would probably struggle to get the approval to move their money offshore. So in many ways, they're kind of constrained, actually. So there really has been an opportunity for a lot of these hedge funds and crypto native prop shops to really take advantage of these arbitrage opportunities. But in many ways, I think Dylan really touched on probably where most of the arbitrage comes from, which is the funding rate. And in the traditional world, this is actually an innovation that I almost guarantee you will make its way into the traditional finance world, and that is the perpetual swap. And the idea is it's a future that never expires. So futures make a lot of sense for oil because there's a storage cost. It's a pain in the ass to stick it in your basement. Whereas with Bitcoin, there's no storage cost, right? It's 12 words. So does it really make sense for a expiring future to have a overly different price? Not really. So what happened is that the market invented the perpetual swap, which is basically as Dylan was saying, there's an interest rate depending on the deviation between the futures and the spot market. And arbitrageurs can essentially come in and do the cash and carry trade to yield that spot. So that's really where I think a lot of the arbitrage is. It's between that spot index and the futures price, where you can actually capture a yield on both directions.
Yeah. Something you touched on a minute ago, Dylan, is the volatility in Bitcoin. If I divide the spot price of Bitcoin at the moment by core PCE, the Fed's inflation target, and we look at the sort of purchasing power of that, we got to an all-time high in February, and it's pulled back a little bit from that point. But the the realized volatility in Bitcoin is still good for me as a trader. I think it's at a really nice level, but it has come off the crazy levels we saw, a couple of years ago, where it was well over 100%, for example. But how much is the volatility in crypto? Do you see that as an attribute relative to it being, to some people it could be a bit of a deterrent, especially some of those people who got burnt a couple of years ago in the big pullback that we saw in meme coins and gold. But how much do you use volatility? Do you think is a positive attribute towards the crypto scene?
Well, yeah. Volatility is definitely your friend, and I say that with a Bitcoin focus. A lot of these, meme coins or altcoins, kind of maybe have a one-off event burst of attention, or maybe you could call it generously a catalyst. But after that, it's usually a trend lower in Bitcoin terms. I actually welcome anyone to take their favorite altcoin or go on, CoinMarketCap and look at any of the top cryptos and look at them in Bitcoin terms. And it looks pretty, even the ones that look somewhat good in dollar terms, in Bitcoin terms, they look really bad. And so that obviously that's a broad statement. But on a long time frame, I generally ascribe that to be true in almost every case. But in terms of the volatility, I will say this: a lot of people, and especially in the depths of the bear, or in kind of the recovery or the chop consolidation phase that seemingly goes on for months or years on end, people will say, "Well, Bitcoin's 30,000. It was 69,000. That's a 55-60% drawdown. That's bad. How are you feeling?" And sometimes even it's like a bit of a mocking tone. And the interesting thing is that a lot of those people that comment that actually haven't even done the math. And when we were at 30,000 in 2023, before the run up to the new highs, for the people that had purchased daily, starting on the worst time to ever start buying Bitcoin, if you started in November of 2021 at 69,000 and bought when it literally went straight down and had since recovered, had doubled off the bottom from 15 to 30,000, you were up like 40 or 50%. And you had outpaced the people buying and holding the NASDAQ. You had outpaced most of the best hedge funds in compound annual return. You had obviously outpaced people that buying bonds and gold as well, doing the same strategy. So it's interesting because the volatility is very much your friend. And position sizing, of course, is key. Yep. Someone that's young like myself and has a high risk tolerance certainly has a different risk profile than, say, my parents.
Than me.
But yeah, and everyone's a little bit different. But the volatility is, as long as it's a scale, an okay size of your portfolio, and it's in spot, which is a real key, right? So if I buy Bitcoin in spot and it draws down 20%, 30%, 50%, I don't really care. I'm not a forced seller. But the people that are throwing on, layering on a lot of this leverage, oftentimes can lose, massive, almost irrecoverable amounts of their Bitcoin due to this volatility. So obviously, it's a plus. It's one of the reasons that there's so much opportunity in this asset, because if it traded like gold, if it traded like bonds, there wouldn't still be a massive, massive opportunity on a long time frame. I joked about this like a month ago, and it was the dumbest friend I know that accumulates Bitcoin just paycheck to paycheck with an auto buy has outperformed the smartest hedge fund manager I know, a brilliant quant. On every time frame that exists. So,
and I think that's actually a key point there. If you look at it from let's bring it to the TradFi world, Sharpe ratio, Sortino ratio, compound growth, however you want to measure it in there's been people who've literally done the Bitcoin price performance and done like a hedge fund tear sheet and then given it out and said, "Hey, there's this fund that I want to invest in. What do you think?" And given it to their managers. And they look at it and go, "We got to call this guy." It's like, well, that's just the Bitcoin price, right? And they're like, "Oh, you got me." But when you bring Bitcoin into the traditional finance world, the numbers are getting to the point now where you can't argue with it. It's just so consistently performative that even the most devout guy who's going to push back, maybe not Peter Schiff, I don't think we'll get him there, but everyone else eventually.
No, he does. I think he does like
capitulate.
some coins. I think he does like some coins. It's just not Bitcoin.
I still stand by that he's one of the world's greatest trolls, and he's a massive Bitcoiner in the background.
Yeah, probably. We talked about a couple of factors. You talked about realized price and how we can use that as a sort of buy the dip kind of level that we could see some support in. But on the upside, an indicator that I see a lot of people talking about is the stock to flow model. Now, obviously, in commodity markets, people use this quite a lot. Gold, we use this quite a lot because it's a scarce asset. So a lot of people say, well, the logic's same in Bitcoin, because it is the scarcity becomes even more as we get closer towards 2140, the year 2140, when all the coins are in circulation, all 21 million. I'll say this to both of you. I mean, I think Plan B's a big advocate of the stock to flow model, and the stock to flow model now is 122,000. How much do I can see a bit of a smile on James's face.
I think you'll get the same response from both of us here.
I mean, I think, but I do see, I think the investment banks have tried to get into this world of trying to value Bitcoin, and they've used the stock to flow model, which, obviously has its critics. So shoot the theory down.
So to kind of put a bit of a sense of scale on this.
Have you got a chart of it as well?
No, I don't, and there's a very good reason why I don't. I think you won't find the stock to flow model in any of my charts. In fact, one of the so in the 2021 era, the stock to flow model was kind of the everything. Everyone was looking at it. I'm of the view, and many very, very far more qualified than I statisticians have done work to show that there is absolutely no correlation whatsoever. You could literally get the same kind of correlation by the amount of steps that you've done over the course of the last couple of weeks. So in many ways, it's a spurious correlation. However, it is very good at memetics. Now, one of the main reasons that I actually went down the path of saying, all right, I need to get really good at this on-chain data thing, is to essentially just give people an alternative to what is, I think, an enormously destructive and horrifically poorly designed model by a man who simply can't take critique, which is Plan B. So I have very little time for the model, to be honest, but I do find it very funny that you're right, there are investment banks. And in fact, Dylan, it might have even been at one of your talks in Bitcoin 2022. A couple of guys asked me that same question, and I gave a very similar tirade to what I've just given. And they said, oh, we're actually Plan B's friend. And I was like, oh, God, what have I walked into right now? But no, I don't have much time for that model, unfortunately.
What you, Dylan? Similar?
Yeah, well, look, all models are wrong. Some are useful. I think the stock to flow model is unique in that it maybe got people to think about, okay, how do the actual mechanics of Bitcoin work? What is the difficulty adjustment? How is this supply algorithmic? Right? How does this system tick? How is 21 million Bitcoin enforceable? Right? That's okay. That's great. But the arbitrary price targets, right, I think are, again, they're somewhat spurious, and just some of the stuff we talked with on this, over the past hour, right? We have so much insight on, every 10 minutes, there's new insight, there's new data. We have this living, breathing, mechanical organism that's globally distributed, that's telling us all this stuff. To say, well, once every 4 years, number go up, I think is a bit of a disservice. I think really the key to actually valuing this asset, and there's a bunch of different ways you can do this, and you can assign any of these variables as you want. But look, we live in a world with global debt to GDP higher than it's ever been in basically every developed country on the planet. Right, with demographics that are not improving and actually worsening. So we live in a world where financial repression is a must going forward. And in a world where there's 100, 200, 300 trillion dollars of fiat denominated liabilities, bonds out there, what's the value of an absolutely scarce bearer asset with, this is the real key, among other things, when you're talking about the halving, when you're talking about these miners, and you're talking about this hash rate, the real key to understand, if you're thinking of it as a commodity, if you want to talk about stock to flow, great. Well, what is gold, silver, all these other monetary commodities? One of the keys is their production cost. So Bitcoin has a programmatic production cost. It's a digital synthetic commodity with a programmatic marginal production cost that's only increasing. So you have an absolutely scarce asset that's becoming programmatically, verifiably harder to produce. So what's the value of that in a world where the ECB, the BOJ, and the Fed, and the Bank of China, and every central bank on the planet have to competitively debase? And, in that world, all your models are destroyed. So, The stock to flow model, I think, it's been useful to some. It got a little ahead of its skis in the 2021 market. But that's okay, right? Again, all models are wrong.
Yeah. I'm going to wrap it up in a minute, but I'm just going to give you a chance just to, if there's anything else you want to bring up. I've got a pretty clear idea about where Dylan sees the long-term future of Bitcoin. But James, is there any charts that you wanted to sort of show up before we wrap it up? And what is the big kicker for you for in the near term to medium term for crypto?
Yeah, absolutely. So, I mean, look, I'm as optimistic as Dylan is. I think Bitcoin's in a fantastic position in terms of where the world is at. I think the world needs an asset like this. In terms of some near catalysts, we can bring up the chart. So I think the first one that just really, I think the ETFs are quite remarkable. We've obviously seen a big slowdown over the last couple of weeks. But I think the next chart, so this is the total inflows broken down by each ETF. Now, it's important to note that the red down the bottom is GBTC, and this is what I would consider to be structural sell side. They have to sell these coins over time because people have been in, there's a whole plethora of reasons why that will happen. But if we remove GBTC, there was a lot of concern that all of the money that flowed into these other ETFs was going to be fast money, and the first correction it would sell out. And I'm just not seeing any of these ETF hands selling, which to me is just, that means that supply has just gone in. And again, speaks to why we've got this basically no 20%.
It's all retail, I hear. Yeah, that's what they're all saying. It's all retail.
A large portion of it is actually seems to be retail. So we're very early. A lot of the wirehouses haven't even switched on yet. Right. Two more charts just to kind of wrap it all up. We were talking about the funding rates before. What you actually want to see is funding rates really correct and take out all of this leverage. And we've seen this happen. So all that excess long leverage and people bidding up the price, we've seen that get washed out over recent weeks, which is very constructive. And that exact same framework, but coming into the on-chain world, this oscillator is looking at the amount of profit or loss. And if you're the contrarian, right, let's bring really short-term trader, you want to see people buy high and then panic and sell low. And that is exactly what we're seeing going on in this green box. These little undercuts where you get the red zone and then it rapidly recovers, that's telling you the people who bought recently, which is the highs, bought high, are selling low. That's what a washout looks like. So you've got ETFs that look good, you've got spot that looks good, and you've got the futures market that's calmed down. So overall, it's a pretty healthy picture as it stands. Yeah.
I'm not a massive buyer of dips. From a momentum perspective, I want that rate to change to pick up. So I like to buy the rip after the dip, if that makes sense. So I'll let the aggressive guys go out and buy this pullback, and maybe whales or whoever it's going to be. But I like to see volume coming in, a bit of momentum coming in. So I'm a buyer of the rip after the dip, and I think that sort of is the next stage.
And if you're looking for when that rip might be about to become a dip, you want those very, very high green values, because that means that a bunch of guys are taking profits, and that profit taking is essentially what's going to put the top in.
Perfect. Dylan, have you got anything else before we wrap this up?
No, I think we covered a lot. Again, I really encourage everyone, that's interested in some of the stuff to check out some of the stuff that Checkmate has built out. Checkonchain.com. It's a fantastic resource, and it's free.
Brilliant. Well, we've covered a lot of ground. There's some exciting times ahead. Obviously, we talk about the reduction in supply, but from a demand perspective, we are seeing governments around the world warming towards the ETF side of things. We're going to potentially see an Ethereum ETF over time being developed, although it's been pushed back a little bit. The fund flows into the crypto cash ETF aren't going away anytime soon. Dylan talked about currency debasement from global central banks, this debt pool, which continues to increase. I think the US debt's well over 36 trillion, and that's going only one way into an election. No government's going to want to cut back in that anytime soon, because you obviously just lose an election. So there's a lot of kickers to go. An interesting time. We also, what I thought was very interesting, covered a lot of these on-chain data metrics, which James puts out, which can really give a good insight around the flows, who's buying what at what time, and some interesting oscillators which can complement traditional, technical analysis like Bollinger Bands, rate of change, oscillators, those factors as well. So definitely something to keep out. Anyway, thanks to everyone for watching. I want to obviously extend a thank you to James and Dylan. If you want to get in touch with them, you can obviously see their details. I'm sure they'd love to hear from you and how you guys could work together or work together. So anyway, thank you. If anyone's got any questions around trading crypto with Pepperstone, obviously reach out to the team here as well. Bid you well.
Cheers.
Thanks, Chris.
Thanks, guys.